Think we're good, right?
I think we're good. We're ready to go.
All right. Hey, everybody. It's Courtney Carrozza, Dampman with Keller Williams Real Estate here. I'm here with Ken Jordan from RoundPoint Mortgage today. Ken's a local expert in the mortgage industry, and he's one of my preferred lenders that I use for my buyers. I asked Ken to join me today because I think that a lot of people are starting to get very concerned who are looking to buy right now with what's been happening with the interest rates. So me and Ken are here to just kind of explain what's going on with the interest rates, what's been happening, what to look forward to, and then hopefully offer some solutions for buyers to make them feel a little bit more comfortable with the buying process right now. So Ken, did you want to introduce yourself?
Sure. Ken Jordan, RoundPoint Mortgage, as you mentioned, one of your preferred lenders. Hopefully someday the preferred lender. No, I'm just kidding. No pressure. But no, yeah. So been working in this market now for 20 years. Been through the market crash of 2009 through 12, and been through the whole pandemic run up, and here we are today, just another day and another cycle of the real estate market. And honestly, I'm pretty excited about the real estate market. I know that may come off as insincere if you don't know me, but it's true. I really think that home buyers, while we may not be, as a home buyer, may not be in the best place of leverage, I don't think that we're as bad off as some people might think. I think that home buyers still have some great opportunities out there for the long run, and I think that story needs to be told.
Awesome. Well, thank you, Ken. Excited
Sure.
to have this conversation with you today. So the real thing that's been concerning buyers right now is how much interest rates have gone up since the fall. We were very, very low in the fall, and now we're over 6%. A lot of times over 6.5%, which is a lot higher than what people are used to right now with the way the real estate market's been. So not only are the prices high on houses, but interest rates are higher. So we just kind of real quick wanted to explain the components of a monthly mortgage payment, so that way you can understand how the interest rates affect. So do you want to just kind of briefly go over that, Ken, why it's so important?
Sure. So without getting like too into the weeds with the math, there's three primary components to your monthly mortgage payment. Four in some situations and five in others, but I'll start with the basics. So principal and interest is the first thing that goes into your payment. Principal and interest is based on how much you're borrowing, the interest rate you're paying it back at, and how many years you're paying it back at. So your principal and interest on a 15-year term is going to be higher than your principal and interest on a 30-year term. Okay, that's pretty basic. The second component of your mortgage payment is going to be your homeowner's insurance. Now, your homeowner's insurance is a company you'll choose. You take that annual premium, divide it by 12, and that's going to be how much you pay into your mortgage payment each month for your homeowner's insurance. The third component is real estate taxes. Now, you realize real estate taxes play a huge role in your monthly payment. If you're buying in an area where taxes tend to be higher as a percentage of the sale price, your monthly mortgage payment might be higher than a friend of yours who bought, let's say, in Delaware, where their real estate taxes are much lower, or in the city of Philadelphia, for that matter, where their real estate taxes are much lower. So where you buy has everything to do with your taxes, and your taxes has everything to do with your monthly payment and what it turns out to be. Now, the other two components, well, if you're putting less than 20% down, in a lot of cases, you're going to have mortgage insurance. There are some situations where you don't have to pay mortgage insurance, and I'd be happy to talk about that at some point if you'd like. But then also association fees, if you're buying in a condo, that's also going to factor into your total monthly housing expense as well. But basically it's principal, interest, taxes, and insurance. And we call that PITI, principal, interest, taxes, and insurance. Not very creative. And that is that's your monthly payment. So when we talk about interest rates and how does the interest rate affect your monthly payment? Well, quite simply, when interest rates go up, obviously the cost of borrowing goes up with it. And interest rates are up from the fall, which the fall might have been, close to all-time lows, to a point now where they are, I would say closer to generational lows. Like they've been lower, they've been higher, but not so much in the lifetime of most of the people that are buying their first or second home right now. Most of us who are buying our first and second home are used to hearing rates that, are lower than what we're seeing right now, but it's not the end of the world. It really isn't. But that's kind of what goes into a monthly mortgage payment.
Awesome. Thank you so much. So I think that we've pretty much touched on the issue at hand here and what, we're trying to provide solutions for to our buyers. So Ken, you and I talked a little bit prior to hopping on here about, what's coming with, with the economy and how that may affect interest rates in the next year or so. So what are your predictions with interest rates?
Predictions. So put it this way. I couldn't tell you 100% where interest rates are going to be any more than I can tell you where Bitcoin is going to be a year or 2 years from now. But there are some things that we can rely on, historically speaking. Number one is, well, let's talk about why are interest rates going up? Interest rates are going up primarily due to inflation. The inflationary pressures are causing a lack of demand for low coupon, low rate mortgage-backed securities. Why would you invest in something that's going to get you a 3.5% return when inflation is pushing 6, 7, and 8%? So that's a big factor. Now, what the Federal Reserve is trying to do to combat inflation is to cool the economy down. One of the tools they have at their disposal to cool the economy down is something called the federal funds rate, which is the rate at which the banks lend to each other. It's the rate that drives credit card rates. It's the rate that drives home equity lines of credit. It doesn't drive mortgage rates, but they tend to move in the same direction. And with that, their goal is to try and prevent or put inflation in check. And the result of most of these monetary policies typically is a recession, okay? If we fall into a recession and inflation is still a problem, that's going to be a big problem. That's going to be a much bigger problem. If inflation still maintains, high levels of growth and we're in a recession, then that could be a recipe for, for tougher times. But let's assume for the moment that the Federal Reserve does what the Federal Reserve does. They increase the federal funds rate, they increase the cost of borrowing, they slow the economy down, and we do go into a recession. Not the end of the world. We saw a decrease in the GDP in the first quarter. It's anticipated we're going to see a decrease in the GDP in the second quarter. And if that's the case, then we are technically in a recession. If we're in a real recession, remains to be seen. But here's the good news. Historically speaking, interest rates have come down in a recession, okay? And with that, if historically speaking, if it plays out that way, then the houses you're buying today, while you might be paying a higher interest rate, and you might even be paying a higher sale price, you could be paying a higher sale price 6 months from now, right? I mean, we'll talk about that in a second, but if interest rates do come down, then you'll have the opportunity to potentially refinance out of the interest rate that you're currently getting into right now as a home buyer. Right. Inventory, Courtney, you tell me. Is it right now? We are still at a pretty low point with regard to inventory. Is that correct?
Yes, still at an all-time low. We have so many houses or so many buyers, especially over the past several months, that have lost offers and have been displaced at this point and are still looking. So it has not gotten much better in that scenario, for sure.
And what are the alternatives to buying? Well, one is moving with your parents. Moving with family members, cohabitate. 2 is rent. 3 is buy, right? Those are the 3 options for where you're going to put a roof over your head. Now, renting is no fun right now either, correct? We're seeing rent increases go up year over year. And the option to rent basically might save you some money monthly, but you're not building up any equity. And you're not able to do what you want to do to the house, not able to improve it and benefit from those improvements. So while renting is an option, I don't think that renting is necessarily the best option, but it might be for some people. So the question is, well, with this low inventory, what's going to happen with sale prices? Well, maybe we're not going to see 20% appreciation year over year in the next 12 months, but we're not going to see depreciation because we still don't have enough houses to sell to the people that want houses, right? So even if we saw a 3% or a 4% or a 5% appreciation rates over the next few quarters, it's still better to buy now going into that appreciation as opposed to going into a down market. In 2009, interest rates, the interest rate recession equation was a little bit out of whack. And that was primarily because the lead up to 2009, the housing crisis, the bubble of 08 was like nothing we've ever seen before. And it's not what's going on right now. We should not see that. What we should see is we should see interest rates come down. So as you
Right.
say, you can always refinance the interest rate, but you can't refinance the sale price. So the house you buy today for $350,000, you may still be spending $360, $365, $370 a year from now. Whereas if you buy today, you pay a little more in interest rate today, you can always refinance that rate down, and you're kind of locked into that 350 purchase price rather than 385 or 390, a year to 18 months from now.
So
it's not a bad thing, right?
No. And I mean, just going on listing appointments constantly, I'm always looking up, seeing what the trend is with the sale prices and, all areas through Delaware County, and they're not going down. That's the reality right now. Inflation is still going to happen with, the housing market, as long as, like Ken said, we have this shortage of inventory. So, just a quick thing as a buyer too, if you are already pre-approved and working with an agent, you want to make sure that you're going out and seeing houses that your pre-approval is up to date and accurate, because rates have been so volatile, and you want to make sure that you understand your monthly payment before you're walking into these houses. I mean, you might be looking at a different price point at this point, and there are some solutions that, you could do upfront if it's worth it for you, depending on your specific situation, to try to bring the rate down, at the time of you borrowing, without depending on refinancing in a year or two. Ken, did you want to talk a little bit about adjustable rate mortgages for a minute?
Yeah, sure.
Different options that you have.
So adjustable rate mortgages are our solution, and how they work is typically adjustable rate mortgages always have a fixed year period. So it might be 3, 5, 7, or 10 years fixed, and then it'll adjust each year after that. The adjustments are typically capped. So let's say, for instance, they can't go up more than 2% in the first adjustment period and 5% over the life of the loan. Okay, so they're usually capped. And they usually follow an index, and it's a little more complicated, but depending on the index that they follow, as that index changes, so would your interest rate. And then there's the index plus a margin, and your rate would be the index plus the margin, and it fluctuates with that index. And it'll fluctuate once you get into the adjustable rate period, but it's fixed for the first however many years you choose to fix it for. Now, the rate on a 3-year fixed versus a 5-year versus a 10-year, the rate on the 3 is going to be lower typically than that of the 5 or the 10. We're in a weird environment right now where that's not necessarily the case. Short-term interest rates are actually, they're called an inverted yield curve, where the short-term interest rates are actually closer to the long-term interest rates. So you're not getting any value in the 3 and the 5. But it does look like we're seeing some value in the 10-year fixed, which means that if you think you're going to be there for less than 10 years, an adjustable rate very well may be the solution. You're going to want to make sure that you really hash it out with your mortgage provider, that whether or not the adjustable rate is the way to go, and what the cost of the adjustable rate is, as well as how is your credit score, your debt to income ratio, and your down payment going to impact that adjustable rate mortgage. But it is absolutely a way to save money in the short term with some risk in the long term. If you're there for 10 years, 15 years, yes, you might end up in that adjustable rate period. And at any point, if you're not comfortable being in an adjustable rate, you're going to want to refinance into a fixed rate. But they call it the fixed rate bump, which means that going from an adjustable, it's in its adjustable rate period, the fixed rate's always going to be just a little bit more. So you're going to have to bite the bullet at one point and take that fixed rate so that it can't go up anymore, versus if it continues to go up and now you're chasing that fixed rate to the point where you might refinance, you might refinance and say, oh man, I should have done this a year ago. But ultimately that's for some, if you're doing the 10-year fix, that's a conversation you have 9 years from now,
Right. So if you're locked in at 5.5%, I'm sorry, go ahead, Ken.
I was going to say, which could be a whole new cycle, so a lot can happen in 10 years.
Well, say you're locked in at 4.5 or 5.5% on a 10-year, and I don't know, 2 or 3 years from now, they go down crazy low again, like 3.5%. You can refi at any time, right? If you plan on staying there and it makes sense financially.
There's no prepayment penalty on them typically. So you want to ask that question. So yeah, you could refinance into a lower fixed rate at that point.
Awesome. And then what about, some opportunities to, pay a point to buy down your rate so that, you can pay a little bit more at closing, but save some money in the long term.
So 2 things. One, I'm very excited about just that, Courtney, because in normalized markets, your what you get for your buy down typically is not as good as what you're getting right now. There's a tremendous value currently in buy downs, whereas in some cycles in the past you weren't. What do I mean by that? Well, let's say for instance you were to pay 1 point. Okay, 1 point is 1% of the loan amount. Okay, so on a $400,000 loan amount, that would be $4,000. Make sense? A half a point is 1/2 of 1%. That would be $2,000, right? Now, we use the term basis points, which means that like 1 point is 100 basis points. A half a point is 50 basis points. A quarter of a point is 25 basis points, so on and so forth. Because sometimes you don't even need to pay a full point. You may only need to pay 83 basis points to get the next rate down or 2 rates down on the rate stack. What we're seeing right now is in the past, a point might buy you 1/8 or 1/4 of a percent in reduction in your interest rate. And then what you do is you see what it's saving you per month and you do a quick break even analysis. How much did it cost me up front? How much am I saving? And then what's my break even? The rule of thumb, 5 years ago is like, if you're breaking even on those points in 4 years, then it's probably a good bet. What we're seeing right now is for the 1%, for the 100 basis points that you might pay, you're seeing 3/8 to 0.5% reduction in rate. Now, it changes every day. It really does. Every day the rate's published and you look at the stack and say, here's what 0 points is. What would it cost me to get a quarter or 1/8 lower? So it does change every day. But what we're seeing, the trend is that we're getting a lot of value for that 1 point or for that 90 basis points or that 125 basis points. And I think before we jumped on, and of course I'm logged out now, but before we jumped on, we did a quick scenario, $500,000 sale price, $400,000 loan amount. And I think we went from 6 1/4 down to 5.75 for 105 basis points. Now on a $400,000 loan, okay, that was saving like somewhere, do you remember, it was like $170 a month or something like that?
It was like $161, yeah.
$161 a month, I think is what we were saving in that scenario. And I think the break even ended up being about a little over 24 months. So if you think you're going to be in the house for 2 years, you can't get hurt, right? And again, that's going to be based on how much you're putting down, the credit score and things like that. But that's a conversation for us to have. And that's also the reason why you want to work with someone that and you're not just dealing with, a customer service center for your mortgage, because you should be having this conversation with your lender. And it shouldn't be something that gets glossed over. And in that conversation, you should look at what would an adjustable look like? What would it look like if I paid a point? What would it look like if I put less money down instead of paying points, which is another option? And all that is an important part of the conversation. Right.
Yes. So I think our big thing here is, if you want to buy right now, if you need to buy right now, let's look at whatever possible solutions that are out there for you. And maybe there's just a couple additional educational conversations that you need to have with the right people to make the decision and, make an informed decision as a buyer, as opposed to completely ruling it out, and, we're always here to provide you with any type of value at any time, even if it's the right time for you or not. So I think that's really, for us, we both wanted to have this conversation with, our clients and our sphere, and just let everybody know that, we're here to have these conversations and help you make the right decision. So I think that's pretty much it, right, Ken?
What's that?
I think that's pretty much it, right?
I think we covered it all. Absolutely. Like I said, I think, I'm excited for the fact that we have, tremendous value in the rate stack and in paying the points. I'm excited for the fact that, although a recession sounds like bad news to a lot of people, and it is, I don't want to downplay that, but, I do believe that there might be some lower interest rates in the next couple of quarters. And I am, I do think that the appreciation rate will slow down, which kind of gives the buyers some breathing room. And, from there, we'll see what happens,
Definitely. If you have any questions about the interest rates or anything that we just talked about, options to buy down or adjustable rate mortgage options, or even, what your current fixed rate option would be right now, feel free to reach out to me directly. I'll drop my contact information down below, and, just let me know what you need. And thank you everybody for watching. And thank you, Ken, for all the great information. You're always so educational and, you know, awesome. So we appreciate you.
Hopefully I didn't just blabber on too much.
No, I know. We love to hear it. We love to hear it. We need to know this stuff, right? So, all right, guys, have a great day. I look forward to seeing you all soon and take care. Bye.